Hi everyone, this is Mike Kramer of My Capital. Today is October 8th and it's around 5 o'clock in the afternoon. So the big day will be on Thursday. That's when we get the CPI report and initial jobless claims. The CPI report's not really expected to be anything of significance based on analyst estimates. We're looking for a 0.1% month-over-month increase on headline, a 0.2% month-over-month increase on core, a 2.3% year-over-year increase on headline, and then we're looking for a 3.2% increase on core. Then on Friday, we'll be getting the PPI report. The one thing of note with those estimates is that swap pricing is suggesting that the CPI report comes in at 2.4% on the year-over-year. And when we look at the month-over-month, pricing is suggesting a 0.16% month-over-month increase, which rounds to a 0.2. So what this is implying to me is that there's a chance here that when the CPI report comes out on Thursday, that you may get a reading above 0.1%, and you may get a year-over-year number of greater than 2.3%. That obviously also means that there's a chance you could get a hotter than expected core reading. So again, we're just looking at the swap market and taking that and looking versus analyst estimates to come up with this analysis. But again, what it suggests is that there's that chance that this number could come in hotter than what the analysts are pricing in. And so obviously that would be, and that's important because if we continue to see a hotter than expected CPI, that's going to result in fewer rate cuts here from the Fed, and that's going to potentially undo, or rather, it's going to potentially weaken the euro further against the dollar. And we've seen a very sharp turnaround in the euro over just the last couple of days. Really, a lot of it has just changed since the job report. And it looked like the euro could go higher, and it looked like we were maybe going to around 112.5. And then we get that surprise job report, and everything changed. And so, again, you saw the euro materially break down. We came back in through the flag. We broke the uptrend, and now we're sitting on support at 109.5, facing a potentially hotter than expected CPI, at least based on CPI swaps, which again is a market-based instrument, potentially suggesting that the euro break lower again back towards 109 and potentially as low as 107.90 or so if you were to get a hotter number. Now, I don't really know how much a cooler number changes anything. As long as the number comes in line, I don't really think it's going to have as much of a material impact. But again, if you were to get a number hotter than expected, like the swaps are saying, that's your risk here to the downside. And it's really the same thing versus the pound. You've seen a very sharp turn lower in the pound, meaning a weakening since the last time we touched base. And again, the job report and some comments out of Andrew Bailey have helped to really weaken the pound versus the dollar rather dramatically. And you can see that the pound has now moved down with the big level of support down here around 130. From its current level about 131. So again, momentum has clearly shifted here, and if we were to get a hotter CPI again, there's a chance here that you could be looking at a pound that's going to slip back into the 128 region. And when you look at the yen has moved up towards this 149.25 level. We noted that the 146 area was a very important level of resistance and that we had been seeing momentum changing and turning higher. The yen did get a little bit overbought in this region here based on the Bollinger Bands. And the 20-day moving average, we were able to kind of get above that and hold it. And so again, this is the level right here around 149.25. I think if the CPI report comes in as expected, you're not going to really probably see much movement out of the yen. If you were to obviously get a hotter than expected number like pricing is suggesting, you could see a move back into the 150 region pretty easily, maybe into this 152.5 area could be a region that could result in terms of where this may be heading. Again, we're just going to have to see how this data comes in on Thursday. When we take a look at copper prices, at least you can see that they've moved down Again, we got kind of overbought in this region, and now we're coming down and testing the 20-day moving average. Obviously, the news out of China last night I don't think was as bullish as everyone expected it to be, and that's had copper move down and a couple of other key metals that are important in China's economy, such as iron ore, have all weakened pretty dramatically the last couple of days. And so right now the 20-day is your big level here. Obviously, a break of this is going to potentially send us back to this 430 region, and potentially further, maybe all the way back to around 415 or so at the very end of the lower Bollinger Band. I just, again, based off of the data and information I saw, it doesn't really seem to me like what China is proposing currently is going to be enough to really save the economy. But that's my interpretation. And again, looking at these charts, looking at how overextended it got, looking at the momentum beginning to shift lower, would kind of suggest to me again that the downside risk is probably greater at this point. Gold is also moving back. You can see we finally moved back to the 20-day moving average, which was something we had been looking for a couple of weeks. Although we didn't move down, we ended up consolidating more sideways. So at this point, this is your big level. If it doesn't hold, you're likely to see gold probably come down and test this 25-30 region. One reason why it may not hold again is if you were to get a hotter than expected CPI number, I guess the initial reaction may be, well, then that should mean inflation goes higher. But the one other thing is that it also may mean that rates are higher and the dollar is stronger, and that may be a weight on gold, just because higher rates mean higher carrying costs, stronger dollar means gold depreciates in dollar terms. So it may not necessarily be a positive thing if inflation comes in hotter than expected. For this month's reading. It's just one way to think about it. When we look at the DAX, it's pulled back a little bit over the last couple of days. Again, we were pretty overbought earlier at the end of September. Now we're basically back to sort of a more neutral footing at the 20-day moving average. Germany has a lot in terms of exports to China. So obviously you want to watch China, see how that's doing, because if you continue to see China slipping, that may weigh on the DAX, potentially pushing it back down towards this lower region here around 18,700 or so. If you just take a more detailed look at it, you can see there's just been a lot of choppiness in the DAX more recently, and the trend has been lower, and we did fill one gap so far. And you can see there's still plenty of gaps to fill, going all the way down to 18,180 or so. So this is one spot that you'll want to watch right in here at 18,970. The FTSE was also weaker today. This was also because, again, China weakness. You have metals and mining down. You can see there was a rising triangle here. We clearly broke this uptrend. That's probably pretty negative for the FTSE. You can see this is support in here at 81.85. If 81.85 breaks, then we're talking about a return to this area potentially in here, which is somewhere closer to the August 5th levels, and that's going to be important to keep an eye on these commodities and how China trades. The NASDAQ was a little bit higher today by about 1%, erasing the losses from yesterday. The market really here in the U.S. hasn't really done very much. You can see this is where we were on September 26th. This is where we are today. So we've really just been chopping sideways. You can see that I was playing around with the idea of this being maybe a head and shoulders pattern. It could still very well be. It's just that perhaps the shape has changed a little bit. I'm not really sure at this point regarding that. This is obviously a major level of resistance at this 20,135 area, because this was a previous high. And then you're talking about potentially going all the way back up here to 20,270. This obviously was a day when the market gapped significantly higher following Micron's results, and then the gate back subsequently after that. So this is a key level here. If we can break that level, then you have room to get back to 20,300. Otherwise, you have this giant gap down here to fill from yesterday, from today, which is a hole-in-the-wall gap. You can see that's very similar to what we had right here. This gap got filled pretty quickly, and this may suggest that this gap gets filled pretty quickly. The S&P also really not doing much of anything, just trading sideways. We had this gap lower yesterday, a hole in the wall gap. You could see that got filled yesterday. Today, you can see we have a hole in the wall gap today. That stands the potential to get filled. Very similar pattern here. That got filled. Here you can see the pattern again, got filled. So, I mean, we're just creating all these very wild and weird gap openings. This gap is almost filled. I mean, I guess you could argue it's potentially filled depending on how you want to, where you want to measure it from, but it's a very tight call on that. And so, again, this would really be the only gap that's still remaining out there, 57,660. 57,672, but you can see these gaps where we get these giant hole in the wall gaps have just been happening on a regular basis, and they've been more mean reverting than anything else. And so if you just continue to follow that pattern, you would expect the S&P 500 to give back some of these gains fairly quickly. In fact, if you look at the index from a different vantage point and you get rid of all the lines on it, and if you look at what's been happening here in the market, actually, you'll see 1, 2, up, down, up, down, up, down, up, down, up, down, up. Barely, but that's what it is. If you look at it on the line chart, you can see that day we were up 0.1%. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days in a row, you've been flip-flopping back and forth with the S&P. So if the pattern persists, I guess tomorrow we should be lower. If not, then we're obviously going to be higher. When we look at the Dow, again, very similar types of setups going on here. Although you didn't get as much of a move in the Dow today, still a very choppy market with very big gappy opens. This would be a gap that still needs to be filled at 42,353. Otherwise, we're still waiting for some sort of break of support around this 41,900 area. The funny thing is that you still have this gap opening here, which hasn't been filled, which is also a hole in the wall type gap, suggesting that this gap should be filled at some point, but yet we're still waiting to see if that happens. It would be interesting if we were to gap lower, let's say tomorrow, and then fill this gap over the next couple of days, because that could create an island reversal top, not just on the Dow, but also on the S&P. You could get a similar sort of thing if you could just gap open one of these mornings and break support. But we'll see what kind of happens over the next few days. Anyway, I hope you found this helpful. Until next time, have a great week. Bye.